Okay, so how can a market be, fundamentally short on space? We're talking a near record 1.7% vacancy rate. But at the same time, it records 12 straight months of sustained negative demand.
Yeah, it's a real puzzle. The Coeur d'Alene retail story seems to be fighting itself.
Yeah.
And that contradiction that really defines the third quarter.
Welcome to the deep dive. Today, we're taking a shortcut, getting right into the essential insights from the Q3 2025 Coeur d'Alene Retail Market Report. We're focused squarely on the dynamics of retail, in one of the fastest growing regions in the Pacific Northwest.
That's right. This deep dive gives you the major supply, the demand, and the transaction trends. We're helping you cut through the noise, basically, to focus on what really moved the needle this quarter. And just quickly, since the term's critical here, when we say negative net absorption, what we mean is, well, tenants gave back more space than they actually leased up. Pretty simple.
Right. And all the figures we're citing today, including that surprisingly high sales volume, they're directly from the Q3 2025 market report. Our promise is to get you thoroughly informed on this, complex market in under 15 minutes.
Yeah, for anyone listening who needs a bit more context on specific findings or has follow-up questions, the source material points you to Eric Peterson. His number is 509-903-9077.
Okay, great. Let's quickly run through the top 5 essential takeaways from Q3. What are the headlines?
First up, what you called the absorption contradiction. Net absorption confirmed a full year of contraction. It's sitting at negative 26,700 square feet. That's the clearest signal that, established players are consolidating their footprints, even while the market remains starved for space overall.
Okay, contradiction number 1. What's second?
Second, stable rent growth. Market asking rents, they grew a steady 1.6% year over year. They hit $18.40 per square foot. Now, while that's stable, that growth actually lags slightly behind the national average rate, which was 1.8%. So that kind of hints at some softness maybe in non-prime locations.
Right, lagging a bit nationally. Okay, number 3.
Third, extreme scarcity. The overall market vacancy is just 1.7%, super tight. But that figure actually hides the fact that prime subtypes, specifically power centers and malls, showed absolute 0% vacancy. I mean, if you need large institutional-grade space right now, you simply cannot find it in the CDA.
Wow, 0%. Okay, fourth headline.
Fourth, capital inflow. Sales volume is still robust. It totaled $31.8 million over the past year. And that's significantly above the historical average for the area. It confirms that capital confidence in CDA's long-term growth story, it remains strong, despite maybe some operational headwinds.
So the money is still flowing in.
Yeah.
Got it. And fifth?
And fifth, yield premium. Estimated market cap rates averaged about 7.7%. Now, that pricing is slightly above the national average of 7.2%. It suggests investors are demanding maybe a 50 basis point premium for the liquidity risk and the complexity that comes with this kind of high-growth secondary market.
Okay, so if we had to boil it down to one thing for people to remember, the core paradox here seems to be CDA retail is seeing fierce investment, especially for its best assets. But kind of beneath the surface, tenants are facing structural consolidation. That's creating a fundamental tension that really defined this quarter.
That sums it up pretty well.
All right, this is where the analysis gets really interesting, exploring those key contradictions. Let's dive into that absorption contradiction first. We know the market reported negative 26,700 square feet of net absorption, which, as you said, is a massive swing compared to the historical average, which is usually positive, around 77,600 square feet absorbed annually.
Exactly. That's the core question, right?
Yeah.
If vacancy is still critically low at 1.7%, where's the disconnect? Well, the report points to consolidation, primarily happening in what it calls the remaining Coeur d'Alene market. That specific area lost over 122,000 square feet over the past year. So this strongly suggests that existing large tenants are the ones closing or shrinking. And that's masking otherwise, pretty robust demand from new, smaller entrants.
Huh. So for an owner, say, in a neighborhood center or maybe a general retail strip, that sounds like a tough backfill challenge. What are you seeing investors doing to solve that specific problem? Is it uniform across the board?
Well, property owners are definitely navigating a sort of bifurcated market. They have almost zero risk in those prime power centers we mentioned. But yeah, they face difficulty re-tenanting those larger boxes in general retail spaces. The overall vacancy rate did inch up slightly by 0.4% year over year, which confirms that, space reduction is happening faster than it's being reabsorbed. And crucially, we really have to keep an eye on post-falls. That area recorded the most negative absorption. It lost 1.7% of its total inventory over the last 12 months. So that submarket is really a key indicator for Q4 health.
Okay, post-falls. Ground zero for the absorption battle, it sounds like. So a tight market overall, yes, but that pressure isn't uniform. Let's look into where those cracks are really showing. Let's talk about the submarket rental divergence. You mentioned overall market rent growth, 1.6% year over year. That's actually lagging the 5-year average of 3.7%.
Yeah, that headline growth rate, it's functionally almost useless right now because it masks these huge internal differences. While the average looks, well, sluggish, certain essential retail subtypes, like neighborhood centers, they saw 2.2% growth, and power centers saw 2.4% growth. Both significantly outperformed the broader average.
So the takeaway here is that demand is really hyper-focused. It's on specific, essential, maybe convenience-driven retail formats, rather than, say, general retail or maybe more luxury-oriented locations.
Exactly. That's precisely it. And the most stunning finding in the report, for me, was the submarket granularity. You have Hayden Dalton Gardens with the highest growth rate. It recorded a stunning 8.9% QTD annualized growth in market asking rent. I mean, that's like seeing rents in Manhattan drop, while some suburban corner shopping center sees explosive specialized growth. It's that dramatic.
An 8.9% annualized jump in one quarter.
Wow.
And what was the counterpoint to that? Was there a lagging area?
Yeah, the flip side was the Coeur CBD, the Central Business District. It saw a negative 2.1% QTD annualized change. So that kind of massive swing confirms that investors, they just have to be extremely granular in their site selection right now. Rent performance is completely localized. It's tied to the type of retail being demanded in that specific neighborhood.
Okay, that makes sense. So given that hyper-focused demand and the 0% vacancy in prime assets, let's look at the third critical factor here. The construction pipeline constraints. You'd think with this shortage, developers would be flooding the market with new supply, right?
You would think so, but the reality is precisely the opposite. There are only about 11,572 square feet of retail space currently under construction, total. And it's concentrated in just one property that's at 4010 Bogey Drive in Post Falls. This is nearly half the 10-year average for construction inventory, which usually sits around 22,000 square feet.
Okay, so that very low level of construction, it really confirms that supply relief for this extremely tight vacancy market. Especially in those 0% vacancy power centers, it's just not coming anytime soon.
Correct. And that scarcity, it reinforces two things. First, the price floor stability for existing high-quality properties that are holding their value. And second, the probability of future rent increases, particularly if this current negative net absorption trend levels off, which the forecast suggests it might.
Right, makes sense. Okay, let's pivot then. Let's talk capital flow. Despite the supply and demand tension we've just discussed, the money seems to be moving. The report notes $26.5 million in completed transactions year to date across 33 deals. What's the story there?
Well, that level of sales activity suggests pretty strong investor interest, actually. It's also notable because the estimated market pricing, around $180 per square foot, that's significantly below the national average of $245 per square foot. So buyers are still finding, relative value in CDA compared to the major metros.
Okay, relative value. And we can connect these sales directly back to that theme of granularity you mentioned, right? Let's maybe look at 3 key deals that closed in Q3 2025. They seem to illustrate this market selectivity. First one, maybe a high-yield stabilized deal. A 6,000 square foot property at 1631 East Celtis Way sold in August 2025 for $1.15 million. That works out to $192 per square foot.
Yeah, and that property sold at a 6.3% cap rate. Now, that relatively low cap rate, it confirms the fierce competition for those prime assets. It shows investors are being hyper-selective, just like the renters we talked about earlier. They're definitely willing to pay a premium for stability.
Okay, paying for stability. Let's contrast that with maybe a general retail example. A 4,955 square foot property at 704 W Appleway Ave sold in July 2025 for $910,000. That's $184 per square foot. Given the 0% vacancy at the time of sale, what's the likely play here?
Well, that sounds like it was likely either a core acquisition, targeting a long-term hold, or perhaps an owner-user acquisition, someone looking to control their real estate costs by owning the building. Makes sense in a tight market.
Got it. And then there's a third type, maybe the vintage value transaction. This shows investors willing to take on maybe a bit more complexity. A 4,300 square foot property at 1401, 1405, and 4th St. Built way back in 1935, it traded in August 2025 for $730,000, or $170 per square foot.
Right. Investing in an asset that old, it really highlights continued investment into well-located core areas. But the strategy there is likely different, probably value-add repositioning. This confirms that investors are willing to take on more complex projects in this competitive market, but only if the location is really right. Location, location, location still applies.
So different strategies for different asset types and qualities. If we connect this transaction activity back to the bigger picture, the capital markets, the reported average cap rate for closed sales over the past 12 months was 6.5%, you said.
That's right, 6.5% for the deals that actually closed.
Okay, but that's quite a significant spread compared to the 7.7% estimated market cap rate. That's what, 120 basis points difference? That seems telling.
It is very telling. What's happening is the deals that are closing, they often represent those high-quality, fully stabilized assets. And those command lower cap rates precisely because the bidding competition for that prime product is so fierce. The wider market rate, that 7.7%, accounts for the overall risk and the mix of assets across the entire CDA market. It basically reinforces that investors require a higher yield premium for a market that's smaller and less liquid than the major metros.
You could argue that's a necessary premium given the potential liquidity constraints.
Okay, that makes sense. The deals getting done are the cream of the crop, pushing down the average closed cap rate. So pulling this all together, what does this mean for the final quarter of 2025 and maybe looking into next year?
Well, the report offers I'd say, cautiously optimistic forecast. It suggests the market will remain tight, yes, but also stable. We have maybe two key watch items here looking forward.
Okay, what's the first one? Vacancy stabilization. Exactly. Forecasts show vacancy basically stabilizing right around where it is now, maybe 1.7% to 1.8% over the next few years. It should level out. This suggests that the negative absorption trend we've been discussing is expected to ease up. It's not expected to deepen into like a long-term crisis.
Okay, so absorption stabilizes. And the second key watch item, rent growth.
Rent growth projection, yeah. Overall, rent growth is projected to slow down a bit in 2026. It might drop to around 1.0% growth for the year, but then it's expected to stabilize back toward maybe 2.0% annual growth by 2029. So it shows perhaps a temporary pause in momentum, but not really a fundamental long-term slump in the market's overall health.
So what's underpinning this stability? Despite these absorption struggles we've detailed, why aren't we more worried about a major correction here?
Well, the region benefits from really powerful demographic support. You've got continued population growth. It's projected at 1.2% annually over the next 5 years, largely driven by domestic migration, right? People moving in, particularly from more expensive Western states. That enduring lifestyle appeal, combined with a pretty stable employment base anchored by healthcare and tourism, ensures that core retail demand stays firm. At the end of the day, the structural growth of CDA seems to be overriding the temporary pain of this tenant consolidation phase.
So the underlying fundamentals are strong, driven by people moving in.
Precisely. So the challenge for investors really moving forward is deciding, do you pay that premium for the scarcity of prime assets? Or do you maybe target some of the older, perhaps lower-priced assets, say in areas like the CBD, basically betting that the strong regional growth will eventually backfill the space consolidation that's happening right now? Two different plays.
Fascinating. A market with real tension, but also strong underlying drivers. Well, that wraps up our deep dive into the Q3 2025 Alene retail market report. We've covered the severe supply constraints, this contradictory absorption trends, and the high-yield premium capital seems to be demanding.
Yeah, we hope this analysis gives you the nuanced, maybe block-by-block knowledge you need to navigate what is an incredibly selective market right now.
And as a reminder, for further detail, personalized analysis, or maybe a custom market breakdown based on this report, you can contact Eric Peterson. His number is 509-903-9077. Thanks for joining us for this deep dive.